Index investing or passive investing has grown more popular with investors. Even Warren Buffett touts the benefits of owning an entire index like the S&P 500 over the long term. An example of an index tracking ETF is BMO's S&P 500 Index ETF. It's the largest ETF in Canada that tracks this well-recognized and popular index. It provides exposure to the returns of the market cap weighted S&P 500 index at a low cost, with a management fee of just 0.08%. This broad market ETF makes for an efficient building block in a portfolio, saving you time and effort while mitigating single stock risk. If you're looking for exposure to the largest and most liquid public companies in the United States, this ETF delivers an easy-to-use solution and instant diversification. Commissions and management fees and expenses all may be associated with investments in exchange-traded funds. Please read the ETF facts or prospectus of the BMO ETFs before investing.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 118. As always, joined by the three amigos, Skeet Dicker, IceCap Asset Management, Rich Diaz, PGM Global. What's going on, gentlemen? Boomer?
Hey, man, guys, we're week 2, right? For the new year, 2024.
Wrapping up.
I know. I'm trying out all my new t-shirts. I'm still haven't cycled through them all yet, but I'm getting closer. How about you, Rich?
Are you the Old Navy guy? I can't remember.
Yeah. Old Navy.
That's some dad vibes.
But with prints on them. You know, this is a New York themed one, Steve. So I know you like an all solid one. Sometimes to wear 2 days in a row, you can just wear it backwards. Then the back.
Do you rock that when you go to New York?
Oh my God. I'm so embarrassed for both of you.
I know. Next question. Rich, what's up, man? What's going on in the evenings with you these days?
Not much. Back at the gym. I'm working from home today, which is why I look like a little bit disheveled. And if you see a small Portuguese lady walk through the podcast and start talking to me, even though I've told her very clearly that we're in the middle of something, well, you'll have to forgive me because she will almost certainly interrupt us.
Mama Diaz.
No, all good in the neighborhood. We got horrible weather in Montreal, which is fun for me because I did not miss it. But otherwise, yeah, I'm ready to go, man. Lots of good stuff to talk about.
Hey,
bring her on. You don't mess with old Portuguese ladies.
Bring her on? No, don't say
Bring
that.
on Mama D. Come on, Mama D. We want to see her.
Oh, wait. Sorry. I know we're pressed for time, but I have to say the story. So my mother listens to us every single week. And last week she logged on to watch it on YouTube and she saw the Doomberg chicken and she thought there was something wrong with our podcast. And so she like closed YouTube, searched for it again, clicked on it again, started watching, and the chicken came back up again. And she literally thought there was something wrong.
That's hilarious. We had some good feedback from that episode. But yeah, I had some feedback too, where like I had a couple of people call me after the show and they're like, yeah, it was kind of weird watching this green chicken talk on the screen, but man, that was an awesome podcast.
It's funny. So here we are, like losing audience members, one listener at a time.
Yeah, one listener at a time.
But honestly, if people
I
haven't seen the green chicken, Doomberg, I highly encourage you to like stop this episode, go back, watch that one. That was, I think, one of my favorite interviews to date. But
it's almost as odd as, you know, what's odder, the green chicken or seeing Rich at home like this? Which one is?
Yeah, the green chicken.
Yeah, the green chicken.
Settle down there in New York.
Right.
Anyways, we've got another great guest here today, a good friend of mine, Jared Dillian. For those of you that aren't familiar with Jared, he's pretty active there on Twitter. He's the author of a newsletter called the Daily Dirtnap, which I personally subscribe to. It's like a daily newsletter about markets, and it's just really well written. I mean, this guy's a brilliant writer. He used to work at Lehman Brothers. He was a former trader at Lehman Brothers for many, many years, built up his newsletter list, and eventually became a full-time newsletter writer. But basically all things markets. He's written, I don't know, 4 books now: Street Freak, All the Evil of This World, Those Bastards, which I just read. It was a hilarious book. And he's got a new book coming out called No Worries. It's I mean, I'll let him frame that book up, but it's supposed to be, he's really excited about it. I think it's going to be a great read. If it's as good as any of his other books, I'm sure this one will be just as good. But Jared Dillian, looking forward to having him on. So we'll get to the interview right now. Jared, welcome to Loonie Hour.
Thanks. It's good to be on.
Yes,
Appreciate it.
you're over in South Carolina, correct?
South Carolina. Yep.
Okay.
It is 54 degrees Fahrenheit here today, which is pretty average for South Carolina in the winter. So
Wow, we got like a cold snap here in Vancouver right now. But yeah,
Hey,
so
is that where the Canadian geese go? Do they go down your way, or do they go somewhere else? Where do they go?
do. We see some Canadian geese here. Yeah.
there you go. So we've got I've followed obviously a lot of your work. How are you looking at markets right now? We just had CPI, for example, today come out a little bit hotter than expected, coming in at 3.4% on the headline inflation, expected at 3.2. How are you looking at that? What's your take?
I mean, the data isn't as important as the reaction to the data. And, what you're seeing in the bond market is, the bond market's pretty flat since the release. It's actually up a little bit. I think the thinking here is that the Fed has already committed to cutting rates 3 times. And that's going to happen really no matter what happens with inflation, unless inflation just rips higher. But, this month's reading is a little bit of an anomaly. I don't know how much attention you pay to the Trueflation data, but it's a private real-time measure of inflation that continues to go down. I personally think you'll see inflation, CPI go towards 2.5% this year. Core PCE is already at 2%. You're going to see the rate of inflation continue to come down. I have a large position in bonds. In 2-year notes, it's a little smaller than it was a couple of weeks ago, but basically when rates were 5%, I was betting on rate cuts. And the thesis was that we would get a recession this year. And I'm actually less confident on the recession, but it kind of seems like the Fed is going to cut rates anyway. So that's my thinking right now.
Yeah, I think that's a good takeaway. I was actually looking at the shelter component. Rich, you and I have kind of argued about this for many, many months now, but there's again, Jay Parsons is kind of my follow on that. He's a U.S. housing economist, but he basically shows that U.S. shelter inflation, which is still the largest component to it, actually, in his view, lags by almost 12 months. So he still has, based on asking rents coming down, he's still of the view that that will eventually show up.
And I can tell you that in the U.S., the housing market is weakening, and it hasn't shown up in the data yet, but it's weakened pretty dramatically. Transactions are way, way down. There's nothing selling. Inventories are still pretty low. There's not a lot of houses for sale.
You got your house for sale.
Yeah, I got my house that's part of the inventory. Yeah.
You're supposed to be pumping the bags right now.
But yeah, the housing market here looks a little dicey. Even though mortgage rates have come down from 8 to 6.5, it's still it hasn't really done a lot to stimulate the market. So,
but like,
go ahead,
Rich. I mean,
okay.
I've got a question to follow up on that. But
yeah, just following up on. Just going maybe step back onto the CPI. I mean, this something I look at a lot is services, and I gotten in the habit of looking services less shelter, or excluding shelter, and that's really held up well. Obviously, because the labor market has surprised really to the upside. I mean, do you see that continuing? I mean, we have more people unemployed than jobs available. The JOLTS number has come down, but there are still pockets where it's doing really well, like in construction. Is that something that you pay a lot of attention to, or is that maybe overblown?
Well, I don't know. I mean, but if you look at the last services PMI print, it was pretty negative, and also the employment number was really negative. So I think you're starting to see some weakness in services for the first time in a while. It's been sort of a delayed reaction, but I think you're starting to see some weakness there. So,
okay.
How do you look at this from like a sentiment perspective as well? I know you're the sentiment guy. So how do you look at just positioning overall in the market today?
Well, I think we might have put in a top in stocks today. We're getting an outside reversal. We opened on the highs. We're going to close on the lows. Um, I've been short. I have a small short position that I've had for a couple of weeks. Just looking at the technicals, I thought we were topping out. Sentiment is pretty bullish. It's not extremely bullish, but it's pretty bullish. So I wouldn't be surprised to see 6 to 8% correction over the next couple of weeks at a minimum. So
Is that where you get like excited to get back in after that? Like six to eight, and you're like, you know what, coast is kind of clear.
I don't know. It kind of depends what's happening at the time. So
Yeah.
um,
I mean,
Yeah,
a lot of
you're
the
kind of
oh, sorry.
prepared to sort of position and pivot as you see fit. I mean, you're just kind of a data and sentiment driven guy that, you know,
Well, as a result of being a sentiment driven guy, um, I'm not a trend follower, right? Like I generally don't buy the upper right hand corner of the chart. I sell the upper right hand corner of the chart. So, my style of trading is to pick extremes on the highs and on the lows and catch a 5 to 10% correction and then get out. And if you hit a bunch of singles like that over the course of the year, the returns add up and you do pretty well. So it's a different style of trading than what most people do. And one of the things that I found in my career is that there's a million different ways to make money. And a lot of people think that their way is the right way and it's the only way to make money. And if you're not doing it that way, then you're an idiot. Absolutely not true. Like there's people on Twitter who I see that I think are complete idiots and they're very profitable. They have a style that they use and it works for them and terrific.
one of my favorite ones, Jared, just to give you a plug here, following your newsletter. And I don't follow all your trades, but there's some where I'm like, man, that I like that one. Was the buying like the bottom tick of on office REITs
Yeah.
when sentiment was just like so bad. And yeah, that was a good one, right? I mean, that's just a classic sentiment play, as you said, kind of the contrarian take when nobody wanted office REITs, everyone thinks it's going to zero. We were
Well,
buying that and it
you
turned
know,
out to be a
the
pretty good trade.
the amazing thing about that trade, there was so much noise about commercial real estate, and you had these hedge funds that were shorting these office REITs with like 18% dividends. If you ever find yourself shorting a stock with an 18% dividend, you should get yourself checked into a mental hospital. Like it's not a good idea. So the consensus was that commercial real estate was going to blow up. And I bought SL Green. I bought it at 20, sold it in the high 30s, made almost 100%. And guess what? Commercial real estate is still going to blow up. Like that will happen over time. Okay. But in the short term, the sentiment was so bearish and the positioning was so one-sided that it was just one of the greatest like trade setups of all time.
Yeah, I think that's an important asterisk there is like it's all about time horizons, right? It's not like you're like going long office REITs indefinitely. It's like it's
Yeah.
it's it's a trade, you're in, you're out. Funny enough, looking at US office, I saw there was a report put out there by I think it was CBRE that US office vacancy rates hit an all-time record high just this
It's
last
happening in
month.
Toronto too. There was another same, I think the same company, CBRE, mentioned that in Toronto, those vacancy rates are continuing to ratchet higher and higher.
Do you have a view on that, Jared, in terms of moving forward, I guess like the impact on all these cities, particularly in the US? Have we fundamentally shifted to this, hybrid work model? And I guess what is the future for not only office, but cities and tax revenues?
I don't know if I know the answer to that question. I don't think I know. Um, there's a part of me that says that there will be a reversion to the mean. And companies, look, there are clear benefits to having everyone in the firm in the office at the same time working together. There's synergy there, right? So there's been a loss of that synergy, and I think a lot of firms are going to want to reclaim that the where we were 5 years ago. At the same time, like you can't put the toothpaste back in the tube. Like people worked from home for 2 years during the pandemic. They got used to it. They liked it and they don't want to go back. So I think the middle ground is probably where the truth is. You're going to have some hybrid of that. People working 3-4 days a week, that type of thing. And there are going to be some losses in the office REITs. But it's not, I don't think it's going to be catastrophic. I don't.
You've
Let's
been, Keith, go
let
ahead.
me yeah, thanks. So Jared, let's talk. I mean, I love the perspective on sentiment, and maybe you can share a little bit on what kind of data points you're using for sentiment, but also let's look a bit closer. Over the last 3 years, every single market we're looking at has had extremes. So we're looking at, 2020, 21, and 22, 23 as well. It's 4 years, right? So, with that, I mean, we've gone from 0 to 5, and now 5 people, they're calling for maybe up to 150 points in cuts in some markets here. What markets do you think might get totally blown out, which would then create that extreme sentiment opportunity from your perspective? It could be fixed income, equities, real estate, currencies. And then also, I think we also need to talk about sentiment for Canada. We are Canadian focused. I know you've recently sent out a few of your thoughts on Canada, which could be perceived as a sentiment thought as well. There's a lot of stuff in there to keep Rich away from asking a question.
Well, you you kind of asked me like what data do I look at when I look at sentiment, and I don't really look at data. Like I look at language, right? I look at the types of words that people are using. If anyone ever says on Twitter that a stock is unstoppable or relentless, like that is a good time to lay out a short. Like when it's unstoppable, like that's the time. When people start using words like that, or when people say the stock market will never go down, you start using absolutes like always and never and stuff like that. Like that's when you're usually at an extreme. So there are hedge funds that use sentiment in they use quantitative methods in sentiment to invest. And they scrape Twitter, they scrape the internet, they look at news articles, and they have some computer that looks at this, and they trade, sort of high frequency with stocks, and they make decent returns. But really, like, I think that sentiment is better measured by a human analyst measuring how emotionally charged some of these statements are. That's really where you get your best information. Um, so you asked me like 8 different questions, but I answered one of them. But
Jared, honestly, I could give you like some plug there. Like I said, I've been probably reading your daily newsletter there for, I don't know, 3-4 years at least now.
oh, it's like 6 or 7.
Yeah, see, you probably know better than me, just
Yeah.
auto recurring billing there. But honestly, like I've used it a lot in my own career, just on the real estate space, just trying to gauge, market tops, just look at sentiment. And it's, again, you said you can, like, I don't always look at the data. It's a lot of the times just like, how are people talking about the market? What is the mood? And it's really hard because people look at you and say, well, like, what data are you using? And you're like, well, I'm not really using like a data. You're just out there talking to people. It's like a gut feel.
Yeah.
And I think I've kind of, honestly, for myself personally, I think I've built that up over the years. And a lot of it's just through reading a lot of your work and how you kind of do it. So, slow clap for you on that one. But
So
Would
let's
you
talk about
consider
Canada.
positioning? Oh, sorry. Would you consider positioning as far a part of your sentiment
Yeah,
suite,
for
I would
sure.
say?
Yeah,
And what
because
kind of
I
positioning stuff do you look at? Just for maybe our less sort of our less educated listeners, you could just describe a couple if you don't mind.
well, I trade a lot of futures. So in the futures world, I look at the commitment of traders data. I look at spec longs and shorts and hedgers longs and shorts and stuff like that. Um, and in stocks, you look at short interest. You look a lot of times if you're looking at individual stocks, you look at the types of holders that a stock has. You can look into the list of holders and the 13 Fs, see what types of institutions hold the stocks. Like that's the type of stuff that I look at. So.
Okay, cool. Thanks. We can go to Canada now. I'm curious about your views there.
Well, there was a really interesting tweet. I'm sure you guys saw it that went around a couple of days ago about how the U.S. has grown 47% in the last 10 years and Canada has grown 4%. Um, I don't I don't know where you guys' political leanings are or anything like that. Like maybe you're liberals, maybe you're conservatives. It doesn't matter. Trudeau, somebody, I was actually on the radio today. Every Thursday morning, I go into the radio and we were talking about the 2024 election. And we were talking about the possibility that the Democrats run the table and we have a Democratic president and Congress, and how taxes would probably go up a lot and a lot of things would happen. And they said, what would that do to the United States? And I said, well, it would look a lot like Canada. Like like basically we wouldn't grow, like we would stop growing. It's not that we become a second world country overnight or everything goes to hell, but growth is necessary for survival. And per capita GDP in the United States is close to 60,000, and in Canada it's just under 40,000. Like there's clear differences in growth between the two countries. And a lot of it is because of the policies of the last 7 years, the income tax rates and carbon taxes and stuff like that. So, yeah, that's basically where we are. And I don't think there's going to be a lot of change in Canada until you have political change. So you guys are much more plugged in than I am. So
Do you have well, yeah, to that point, you and I originally got connected over Canadian housing.
yep.
And so yeah, I think I went on your podcast years ago. I think like I think you had a short position on some of the Canadian banks. Kind of curious, if you can walk us through that story and how it kind of played out. And I don't know if you have an updated view on that today, given everything that's going on in the world, but just kind of curious your thoughts there.
Well, the interesting thing about the Canadian housing trade is that thesis. I have never been more wrong on a thesis than I was with that thesis. I was dead wrong, but I made more money in that trade than any trade I have ever done. I was dead wrong and I killed it. I crushed it. So basically, I had three parts of the trade. I was short the Canadian dollar. I was short Canadian interest rates. I was long BAX futures.
And what year is this?
All the way from, well, I'll tell you in a second. I'll tell you in a
Okay.
second. And I was short the Canadian banks. Okay. So I shorted the Canadian dollar in 2013. It went to 146 and I closed out the trade. I didn't close it out at 146, but I came close and, made a lot of money off it. The BAX futures I held until the pandemic. Rates went to zero during the pandemic. So I ended up making a lot of money on that. The Canadian banks, I had a really good entry point. I forget what year, it was probably 2013. I was short the banks for like 7 years. I basically was unch when I closed out the trade, but I had paid like $280,000 in dividends. Right. So I was like, I had like no capital losses, but I had paid out a bunch in dividends. But if you add those three legs of the trade together, it was my greatest trade of all time, which shows that you can be right for the wrong reasons. You can be wrong for the right reasons and still make money. So,
I mean, to give you a bit of credit, I mean, the Canadian housing trade has continued to surprise many, many people, just seemingly against all odds continues to move up and to the right. Of course, right now it's going through its challenges, and I'm kind of curious if you've considered revisiting that trade.
no, I'm not. And basically what I figured out with Canadian housing, and people were telling me this for the last 10 years. They're like, you're a fool to short Canadian housing because you're basically letting in 2% of the country every year. It's because of this immigration and it's putting pressure on housing prices. And I was like, yeah, that doesn't matter. Well, it absolutely does matter. It's going to matter in the United States. We've let 8 million people into the United States through the southern border. Over the next 10 to 20 years, we're going to have enormous upward pressure on housing prices because of that. It's going to start on the low end, but instead of trickling down, it's going to trickle up. So I think immigration has really been probably the number one factor in Canadian housing prices. There's other factors too, but I've got no interest in revisiting that short at all. So
I think there was like another terminology that you had used once, and I thought it was pretty accurate, which is like, the S&P 500, for example, in the US is almost a political asset at this point. And
Oh, yeah.
I would say in Canada, it's like housing. It's like it's a religion. housing is a religion, and it is ultimately dictated and supported by five large banks that run the country and the governments that ultimately are elected.
I mean,
Um,
conversely, stocks are religion in the US, right? The government in the United States cannot allow the stock market to fail. It can go down 10%, it can go down 20%, but if it goes down 50%, the entire like fabric of the country just comes apart, right? Because in the United States, people save for their retirement in the stock market. We're the only country that does this. Europe doesn't do it, Japan doesn't do it. This is our retirement savings. So the stock market cannot be allowed to fail. In Canada, it's housing. In Canada, housing cannot be allowed to fail. They cannot let it fail. So
yeah, I mean, I've said this before, but nobody gets excited about the TSX here in Canada. Um, everyone gets excited about pre-sale condos and rides those into the stratosphere. But
So
Jared, go ahead, Keith. Sorry.
yeah, jump ahead of Rich again. So
Go,
again,
go.
like let's stay in Canada for a little bit here in the housing market. Steve mentions a bit softish now for a while. Is this kind of maybe the opportunity to go in to get aggressive with housing again? Or is it still, sentiment hasn't been washed out at all? What do you see anything on that side with
in
Canada?
Canada or just in general?
Oh, in Canada with housing.
Um, I mean, Canada and US are kind of similar right now because prices of high and the cost of carry is high, right? And also, I don't know about Canada, but the insurance market is all screwed up in the US, so insurance is high here too. So it's very expensive to own a house. It's much cheaper to rent. And I tell people this all the time. Like, if you look at charts in the US of affordability, like affordability is at all-time lows because of housing prices and because of interest rates. Like, even though prices in Canada have come down a little bit, like real estate is still very unaffordable. Now, that's probably not going to change unless you dump 2 million houses on the market, unless you just create a lot of supply. But it's like I don't really see a lot of upside. I don't see a lot of downside, but it's still the affordability is the big problem.
Thank you.
Rich?
My question was to do with you mentioned that in the US, the stock market cannot be allowed to fail, and Canada, it's housing. But would you reckon that that's one of the reasons why the US has been able to maintain such better productivity growth? That you've got capital allocated to companies that ostensibly produce productive assets, and productive assets that they try to return money to shareholders, that they invest in R&D. I mean, R&D spending in the US is almost twice what it is in Canada relative to GDP. Whereas in Canada, our money and our GDP is plowed into what is ultimately not that productive an asset.
That is a very elegant way of putting that. I wouldn't have been able to come up with that myself. That's
Okay.
actually genius.
Oh,
Yes.
well,
The answer to all that is yes. Like
a
for sure.
blind squirrel finds a nut every now and again, I guess.
What else is keeping you up at night, Jared, as we move forward here? Like, I know that up until recently, you were really concerned about inflation. I think you had an inflation trade on. I believe you still have it on. So I'm kind of curious. You've kind of talked earlier in the show about inflation subsiding. You see CPI getting close to maybe 2.5% at some point this year. What are your concerns moving forward? Are you worried about maybe a reacceleration? How are you looking at that?
Yeah. So I'm the psychology guy. So, inflation, the rate of inflation has come down a lot. Um, let's just say inflation is 2.5%. We still have an inflationary psychology. Like people still believe that prices are going higher. Um, and basically the reason that is, people have a memory and they say, okay, in 2018, when I went to the grocery store, it cost $150. Now when I go, it costs $300. Ergo, we have inflation. And that's important because if people believe we have inflation, they behave in such a way that actually perpetuates inflation. So if you think the price of eggs are going up, you're going to go to the grocery store and you're going to buy like 12 dozen eggs because you think that the next time you go to the grocery store, the price is going to be even higher. So you accelerate your consumption, which speeds up the economy, and the economy runs faster. Okay. So we still have this inflationary psychology, and until we break it, there is the chance that we're going to have another round of inflation that could be potentially worse than the last. So there could be a lot of catalysts for this, right? Like, let's say Trump gets elected and in 2025 he does a stimulus package, right? Well, inflation's going to be 10% in a heartbeat for sure. These are the types of things that could happen. I think inflation is coming down right now, but in 25 or 26 it could be much higher.
How are you looking at the U.S. election as well? Just it's obviously coming up here. Do you have any views on that? Potential outcomes?
Well, what a lot of people are, I think, kind of focused on the wrong things. Like people are focused on, Biden's age and his fitness for election and Trump's authoritarian tendencies, and they're kind of missing the point. The election is really going to come down to third party candidates. Okay. So on one side, you have Robert F. Kennedy, who is running as an independent. And you also have the No Labels people. I don't know if you've heard of them, but there's a group called No Labels that intends to run a centrist candidate like Joe Manchin or Larry Hogan or something like that. And they said if Trump is the nominee, they're actually going to do this. So you're going to have a centrist candidate like Larry Hogan, who's going to peel off 5% of the votes, and Robert F. Kennedy is going to peel off 5% of the votes. And the question is, who do they steal more votes from? And the thinking is that RFK Jr. will take away more votes from Trump, and a No Labels candidate will take away more votes from Biden. But there's just like, to make a prediction 300 days out is just foolish. Like, there's too many variables. You can't predict what's going to happen. But I really honestly believe it's going to come down to the third party candidates that turn the election one way or another.
Yeah, no, I think that's it'll be an interesting year. I know everyone up here in Canada is always paying close attention to the U.S. elections as well and the outcome there. So, but I also wanted to talk about your upcoming book here called No Worries. Can you walk us through that? I know you're pretty excited about it. I plugged a few of your books here earlier, but I think you're there it is.
No Worries: How to Live a Stress-Free Financial Life. So this book is, you know who Dave Ramsey is, right?
Yep.
No, I don't.
You
Sorry.
know who Dave Ramsey is?
No.
Yeah, you do. Come on. Are you joking?
Do I? I don't know. I wouldn't
What?
Do you know who Susie Orman is?
Yeah.
Okay. So and Robert Kiyosaki, do you know who that is?
Yeah. That I
Okay.
don't know.
So these are like the three main figures in personal finance in the United States, and they're all ding dongs. Like, they're all just complete idiots. Like Susie Orman says, if you just don't buy coffee, then you will be a millionaire at retirement. And Dave Ramsey says, if you cut up all your credit cards and just use cash and go off the grid, then you'll be fine. And Kiyosaki says you should buy a bunch of residential real estate and laundromats and RV parks and do the passive income thing, and you'll be a millionaire. These are all terrible ideas. They're all terrible ideas. And the reason is because they increase your stress when it comes to money. They increase your financial stress. The two sources of stress are debt and risk. If you have a lot of debt, you're going to be in a lot of stress. If you have a lot of risk, you're going to be in a lot of stress. So this book is about minimizing your financial stress. And if you've ever seen the movie Inception, you know that quote where it's like an idea is like a virus. Like, once you see this, you can't unsee it. You will see it wherever you go. So it's a powerful idea.
And there's can you talk about the portfolio? I believe you call it the Awesome Portfolio. Can you just quickly explain what that is?
Yeah. So the Awesome Portfolio is 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. Most people have 60-40 portfolio and 80-20 portfolio, or they have all stocks. let me put it this way. The prevailing wisdom in the United States is you want to put all your money in the S&P 500 and dollar cost average it. Put it all in and dollar cost average it. Great. The S&P 500 returns a lot. It returns like 9.5% a year. Okay. The returns are great. But if you invest in an index, you get the returns of the index, but you also get the volatility of the index. And the S&P 500 is a very volatile index. It moves about 1% a day. It moves about 16 to 20% a year. You have had 4 drawdowns of 50% or more. You had a drawdown of 25% last year. Risk in drawdowns affect your psychology. Okay. It's very hard to stay invested over a 40 or 50-year investing career when you're taking 50% drawdowns and experiencing this volatility. And what they tell you is just hang on. Just keep putting money in, just hang on. But you can't do it. And even if you could do it, is that desirable? Like, do you really want to be miserable like 3 or 4 times in your life when the market goes down 30% and you're freaking out and you're shitting your pants? Like, why would you put yourself through that? The awesome portfolio returns 8.1% a year with a max drawdown of 12%. 12%, and it has half the volatility of an 80-20 portfolio. So you give up 1% in returns and you have half the risk. It is magic beans. It is the closest thing to a silver bullet in finance that you can get.
No, I love that. For anyone that's listening to this interview here on YouTube, we're going to be giving away 3 copies of No Worries. So just comment in the YouTube section and we'll pick 3 people. We'll get those books out the door. Jared, want to thank you so much for coming on the show. I'm sure we'll have you on again. Your first appearance here on the Loonie Hour, but once again, No Worries. That comes out in, I think, what, 2 weeks?
12 days as of today. It comes out the 23rd of January.
Okay, so anyone that doesn't get picked for those 3 books, highly encourage you to get there on Amazon and grab a copy. I can attest to your writing. Your writing skill is phenomenal, so it'll be an entertaining read nonetheless. And once again, I want to thank you for coming on the show.
Thanks, man. It was great. Really appreciate it.
I thought that was a good interview with Jared there. Like I said, he's a really good writer. Let's put it that way.
Yeah, he has awesome hair as well. I forgot to compliment him on that.
I'm jealous.
He's a good follow on Twitter as well.
Yeah, he is a good follow. Yeah, great sentiment guy. Honestly, people like he's a quirky individual, and so some people maybe have listening to him for the first time. I'd be like, oh, I don't know about this guy. You know, not using any data, just feeling out the markets. But I will say he's got a pretty good track record. So.
So the whole thing, just for people to understand, the whole thing with market sentiment means that if everyone loves a market, it means sentiment is very high, very positive. So by definition, there's no one else left to buy. So it can't go any higher. And then the opposite is also true. If everyone hates a market, then by definition, there's no one else left to sell. So that's why you want to follow sentiment quite closely.
I'll give you give you the sentiment indicators just on like housing. Like when I remember like 2022, right? Because we're getting close to the top, or the summer of 2021. Everyone at like the barbecue was talking about real estate and how much money they've made, and they're buying an investment property because they've made so much on their last house. That's usually like a pretty good indicator of like a sentiment top when everyone's talking about, the returns on real estate. And on the flip side, I remember in the winter of 2022, right, which is still the low for Canadian housing, was when I remember deals were blowing up. I'm like, oh man, I was like, oh, why is your buyer not removing their subject conditions? Well, the uncle called and he called from Atlantic Canada and he told the buyer that it's not a good time to buy real estate, that it's going to keep dropping. And it's like, well, the crazy uncles calling from across country to tell you it's not a good time to invest in real estate. It's usually a good sentiment indicator. So, those are kind of how I just, really trying to tune into the market about what people are thinking and saying.
Yeah. And you also have as well, there are a number of different actual data sentiment indices that have been created, and they cover a whole bunch of different markets. You can find them. And so the thing with like sentiment for us, for example, you always use it as a consideration, but not the overriding one, because something can remain awesome for a long time and something can remain crappy for a long time. But Jared is absolutely correct. It is something you always need to think about. And so like as soon as like when Mama D is talking about a market and she wants to buy it, maybe that's not the time
No.
to buy it.
Can I just add one last thing there before we sort of pivot here is I think the biggest thing I want to remind people is just all about time horizons. Is that every investor, like, whether it's the three of us or someone else, like we all have different time horizons. And so when we're talking about an investment or a trade, it's all time horizons, right? Some people are like long-term investors, and, hey, like you're buying the S&P and you're dollar cost averaging. That's much different than someone that's saying, hey, you know what? I'm making a 3-week bet on interest rates here.
There are some hedge funds that are in and out of positions within the hour. As well. So people need to know that. And so that's, yeah, you're totally right.
I think that's where you get the biggest misconception, right? So
Yeah.
I'll give you, like, I'll go on Twitter and talk about, rates or something or whatever. And they're like, well, you said this about rates. And it's like, well, yeah, I said that 6 months ago.
Yeah.
It's like, if the data starts to change, I think you have to you should be changing your views and opinions.
Yeah.
So
anyways, a cousin of sentiment is positioning, which we touched on briefly with Jared, which people should know is there's a lot of positioning data. There's either surveys of positioning data, which is I think Bank of America, Merrill Lynch comes out one with every month. What is your biggest overweight? What's your biggest underweight? Are you invested in bonds or stocks? And they calculate this. They have thousands and tens of thousands of clients. They amalgamate sort of all this survey data and they pump it out and they sell that or it's research. There's also sort of there's futures markets and you can see how many people are long certain futures or short certain futures. There's open interest, which Jared talked about, which people may not know. It's how many people are shorting a particular stock. As a percentage of the total market cap or the total available stock that's out there. There's just, it goes on and on and on. We can't obviously discuss them all, but there's lots of different ways you can understand either positioning, sentiment, etc.
Yeah, we've people who know us, might have heard a lot of similarities in the, in what Jared was just sharing with us. And like the big thing is you can't stay fully invested in equities all the time. Because, as you get older, you become more sensitive to losses. And plus, as you get older, dollar cost averaging doesn't help anymore because the amount you're putting into your portfolio is minuscule to the amount of exposure that you have. And then, I mean, everyone knows right now over the last 23, 24 years, we had 3 periods where, market has had a 50% drawdown. So, managing, I say all the time, when a market is taking off, professional managers look like losers, you get left behind. But when markets, come down hard, a professional manager should, always do pretty well in that kind of environment. And it is about managing risk. They're not always seeking out return. Speaking of seeking out returns, how can we maximize the rest of the podcast today? How can we bring it up, Steve? What do you have for us to talk about?
Seeking out returns. We've got some discussions here around municipal governments in Canada, particularly as it pertains to property taxes. So I think, Keith, this is a larger secular trend. And I talked about this like a couple years ago, and people were like, oh, this guy's like conspiracy theories, but the writing's been on the wall for some time that, remember during the pandemic, our governor at the time, our municipal leader, his name was Kennedy Stewart, was writing articles in the Vancouver Sun and pleading for government bailout money because the city was on the verge of bankruptcy if they didn't get, cash injections. And so it's really just been a trend. This year we've seen the city of Vancouver has increased their property taxes. I think it was 7.5%. Calgary was over 7%. We just had the city of Toronto, which has been saying, hey, we've got all these difficulties. They just raised property taxes 10.5%. 10.5%. And that's your largest metro here in Canada. I mean, that's a huge whammy to people that are already suffocating under ballooning interest payments on their mortgage. The cost of home insurance continues to push higher. Strata fees on condominiums continues to, those are growing 8, 9, 10% a year. So the cost of home ownership continues to push higher. I think it's definitely going to squeeze people on the fringes. But I think this is also becoming an asset class that it is for the wealthy and the select few. Like, it's just the days of 20, 30 years ago where, you brought home an average income and you were able to save. I just think we're seeing this shift further and further away. That to Jared's point on the interview, let's be honest, it is cheaper to rent housing in Canada and in most parts of the world today.
Well, you certainly have less risk with renting as opposed to home ownership. I mean, our view has always been that governments, they're going to spend every single tax dollar they bring in and then more as well. So they always want more tax revenue. That's just the way we're put together. And, with these property taxes going up now, some municipalities would say, no, we didn't raise taxes. It's still, 0.6% or something, but the assessed value has gone up. That's the way they look at it. And as you know, the more we're dishing out in for taxes or service fees, that's what some of them are called as well. It means, again, there's less money we have left over at the end of the day, to buy stuff. And buying stuff, that's what drives the economy, is not paying taxes. That's not what does it. And we go back into this, one thing we sort of touched on a little bit with Jared was, hey, is the Canadian market now, like the real estate market, is it sort of in a flushed out period and we're trying to buy, or is it still oversold? It's not really in one direction or the other right now. However, if we continue to see soft data coming through, as my view on this, I think the probability for Canada is, so Rich, we have three scenarios going for the Canadian economy. We either have, flat to little growth coming up, a bit of a soft recession, or we get a hard recession. Right? That's what the outcome is right now. The best scenario is that we get flat to a little bit of growth over the next year. And even that is going to be hard, to achieve. What are you thinking there, Rich?
Well, this is why I always go on and on about productivity growth. And this is why productivity growth is so important, because and this is why GDP per capita is so important. It's like if you tax people, but you aren't growing the pie, what you're doing is basically just absorbing more of a shrinking pie. Now, Canada's pie, forgive me going on in this, has basically been flat. If it wasn't for the massive influx of people, we would have already been in a technical recession long ago. And so that's why, this emphasis on taxes and redistribution of wealth, it can't, you've heard me long enough. There are loads of great reasons to do that, in my view. Sorry, Keith. But ultimately, what really the emphasis and the focus should be on is growing that pie. And ultimately taxes will weigh on growth, will exacerbate some of the problems we have. And if we're not more efficient with either the money we spend or the capital allocation that we have, then it sort of eats itself. And there's the beggar thy neighbor policies ultimately sort of are the road to serfdom. And I just, it's not a sustainable way sort of running an economy, in my view. But we'll see. I mean, we'll see how long people will put up with it. People will move. They'll either vote for different. They'll either move like physically. They'll vote with their wallets, or they'll vote, in the next elections, or maybe they won't. Maybe they just love it.
Well, I think that's where we're seeing some migration patterns. Obviously, you're seeing more and more people moving to places like Calgary, cost of living. But, one of the ones I'd pointed out was Soyuz. So here in British Columbia, nice little town, especially for vacationing. Soyuz residents are being hit with a 39% increase on their property tax bill for this year. 39%. I interviewed one homeowner that said her property tax bill was going to go up $2,500 for the year. So that's where it just comes down to
But that must be because the assessed value increased.
No, there's protests going on in a Soyuz, and because
can you give us some context, like what kind of town is it? Like a working town? Is it a commuter town? Is it rich, poor?
lot of retirees, people that will leave the lower mainland that will go up there, retire, buy a home. You're close to all the local vineyards, the lake, so it's more of like a summer place. Lots of tourism, but yeah, you get a lot of retirees and stuff. So the one thing I'd kind of bring up too, just like from the bigger picture perspective, is like, you talk about Toronto's property taxes going up 10.5%. They've had the single largest property boom over the last 10, 20 years. I mean, the growth of that city, they've got the most cranes in North America. I mean, the amount of construction that is happening in that city, all of the rising real estate values that have boosted, property values and development fees and development charges, and they've somehow seemingly squandered that money. You can't imagine if Toronto has a prolonged housing downturn over the next 5 to 6 years. Where is the money going to come from if development, for example, dries up for new housing?
Dun, 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 dun. It's time for the Bank of Canada to step in.
I mean, that's a bit harsh to say that they've squandered it. I mean, Toronto is an outsized contributor to Canada's GDP. It's got a lot of the banks there. It's got good schools. I mean, it's a bit
like
strong.
You could not have had a better economic environment. No,
I agree, and the population growth is there. I mean,
something's squandering
is a
going
bit.
On.
Yeah,
but the challenge with, we're talking about an asset and productivity from an asset, right? So let's just think about, the asset we're talking about is real estate and the banking sector, and they're both one of the other. It's the same thing, really.
Yeah.
And they're both levered entities. So most people see when they're buying a house, what's the leverage? 5 times? 3?
Yeah, it's about
8, 9?
five times. 5 times.
Yeah, 5 times. Most banks are levered anywhere from 10 to 20 times. And so when you get that leverage, you should enjoy it when it's going up. Yeah, absolutely. So I know your comments, Steve, absolutely agree with it. We're say like the oil patch, that's also a very productive asset. And it is levered, because companies are levered, of course, but the leverage in that is significantly less than what, you get from financial, balance sheet kind of leverage. And, again, the challenge we have with Canadians is that we've never seen a deep recession or a crisis developing from, down on Bay Street, basically. And, hopefully it doesn't happen. But if it does happen, it's going to be, it'll create one of those sentiment indicators we were talking about earlier.
Well, that's
in a bad way.
That's the funny thing. I was just looking at some of the data for Canada, and the economic mood, according to Bloomberg, has actually started to creep higher, which I thought was quite weird. So we'll keep an eye on that. But
related to that though,
rate cuts, baby. Everyone's all
yeah, maybe
cut, baby, cut. I was just reading the article, in the Bank of Canada that came out, and they specifically said, this was Tiff. He said there will be no recession in 24, but the first half sure won't feel good. What does that mean, Rich? What does it even mean? It means they never forecast recession, right? It's, hey, you never expect it, and a good household, you should always be planning for things, at least with the conversations.
Speaking of unexpected things, Mr. Guilbeault, if you're listening to this podcast, Hertz, the rental car company, announced today that they're planning to sell 20,000 EVs. Hertz plans to sell 1/3 of its U.S. electric vehicle fleet and reinvest those dollars into gasoline-powered cars due to weak demand and high repair costs for its battery-powered options. So, of course, this is on the just after the Environment Minister Stephen Guilbeault, of course, in Canada, is mandating zero-emission vehicles by 2035. So I don't know. Don't be surprised if Hertz is no longer operating in Canada in the very near future. But I thought that was interesting given all our conversations around electric vehicles over the past couple episodes.
I got another thing to add on the list that should surprise absolutely nobody. Several months ago, maybe last year, maybe it was a year and a half ago, we talked about how Canada's the land of oligopolies. I mean, we don't mean to hate on Canada all the time, but this some of the stuff just makes you like laugh at how stupid and obvious it is. And we discussed how Rogers was buying Shaw. I think the three or four telecom companies controlled 99% of the mobile market share. And lo and behold, right on cue, right after our consumer protection minister came out and said, you know, we're going to watch out what these companies do, Rogers is starting to increase the prices of their some of their mobile services to new customers. This is just to provide some context. Canada already has the most expensive telecommunications services in the world. You can look at the two following sources. One is Rewheel. That's a great source. And you can see, you know, monthly price for 4G and 5G smartphones is the highest out of something like 40 countries and 25% higher than the second and third place economies. So it's just things that should surprise absolutely nobody, but yet
People are going nuts on Twitter too. Like there's a lot of people like posting like screenshots of like their communications with Rogers and you know, stories about old ladies, bills going up, and it's a mess. But speaking of oligopoly, oligopoly, we should call this oligopoly hour. HSBC, of
it'll be
course,
every week.
yeah, that merger with RBC, of course, buying HSBC. That's a confirmed done deal. I think that was approved a couple weeks ago. Of course, you know, Krista Freeland said that this will do nothing to diminish the competition in Canada. For anyone that's in the real estate or mortgage industry, you all know, including myself, that HSBC has always been a historical leader in mortgage rates. They've always undercut any of the big five Canadian banks by 20, 30 basis points at least. So if they're gone, I mean, what is the incentive for the other five to actually be more competitive on their mortgage rates? So Canadians, we've lost some competition there. You'll remember HSBC, this like almost like top tick the real estate market, but HSBC was the lender that during the pandemic they were offering 5-year fixed rate mortgages at 0.99%. Yeah, it's crazy. That was the
free money.
Sub 1% mortgages only offered by HSBC. But again, oligopoly hour, HSBC will be gobbled up here by RBC, and that'll just pass through to mortgage rates this year in 2024, which we still have over about 60% of the Canadians that have yet to see a mortgage payment increase despite all the rate hikes from the BOC. So cut, baby, cut.
Cut, baby, cut. I think the last thing that I want to bring up, everyone, this is something I'm tracking closely quite a bit. And it's a deal, Rich, it deals with the Who. So not the Rolling Stones.
What?
Who?
What?
Who? That's who. It's something that's really interesting.
What are we calling this one? A conspiracy hour?
No,
maybe
please.
this is
I'm gonna get in
not.
trouble.
No.
I know. I always like bugging you.
But it ties into the whole, you know, conversation, because, you know, we brought up Stephen Guilbeault's name there a few minutes ago. But so the World Health Organization, they are probably the last 16 months now, they are developing, I don't know what the correct word is. Maybe it's an agreement that all countries, you know, they're saying, yeah, we will sign this, we will agree to it. But they're trying to coordinate a common global response to any future pandemics. And that seems, you know, great if you think that way. Or, you know, maybe each country should have their own individual response, because then, you know, hey, if you spread out the decision-making process, some people will get it right, some will get it wrong, as opposed to one big correct decision or one big incorrect decision.
Or only correct decisions, Keith.
Or the only one. That's true. Yeah, that's true. But what's come out over the last week is that Canada, so, you know, that's who's ruling in Ottawa these days, they are requesting that the WHO, in the definition of a pandemic, will include something referencing climate. So the idea with that then is that the WHO will then be able to trigger a response as, hey, we now have a new pandemic. It is the climate crisis. Therefore, this is what everyone should now do. So whether that leads to, climate, travel lockdowns and stuff like that. But this is something that, I read about it quite a bit because it does have the probability of really reducing our ability to make decisions, at the household level. And it's not something that's being shared with Canada, with Canadians. And it's something that it's a pretty significant decision that has been made by our government, and yet no one has an opportunity to discuss it. So we're introducing that concept here. So Rich, sit down with Mrs. D and have a go at it.
I think we've been pretty early on a lot of these pieces, but there's been a lot of discussion around like carbon credits, for example, right? Where it's like, okay, if you're an individual, Keith, and you're like, hey, you've been flying a lot. You've been traveling to Toronto to do the Loonie Hour. You've been going to Vancouver, Calgary. Now you're going to go to be Saskatchewan, whatever. It's like you as an individual will either have to buy those carbon credits or maybe you get tapped out, right? It's like, sorry, sir, you've hit your limit for the month or for the year. And, you can't travel, or again, like you have to buy credits to some extent.
If only there was a technology coming up where they could control how you spent your money.
Say no to central bank digital currencies. There's
an update on that, wasn't there, Rich?
No, there was. I mean, I'm not really sure I understand it fully, so I'm not going to comment. But if you have something to say, I just wanted to quickly just jump in on the climate thing. Number one, just remind that a pandemic is an epidemic of an infectious disease. That's the definition. And when everything is climate, then I think nothing is climate. And I think that what that does is it devalues what I think, can be seen as some pretty reasonable things to be doing to lower emissions, e.g. nuclear power, and make our grids more efficient. Efficiency is always good. Efficiency is productivity. And I think what you do is you by just muddying that water, you don't allow for countries to react to the individual circumstances. The COVID was a perfect example. There are different countries that some are young. African countries had extremely stellar results because everybody's under 40, and older countries that are fatter and more north, they behave differently. And by not being able to just do what you want to do from a country standpoint, I think is always a bad idea. But what do we know?
I think that just to add to that point, we do have sometimes we get the odd commentary from one of these episodes and people are like, oh, you guys are, not supportive of the climate. And it's like, nobody's saying that. It's just the way that it's being taken about, the way that governments and policymakers are sort of like stuffing this down people's throat, and just sort of the narrative around all of it and how it's being done is just, I think, wrong. But,
well, Bloomberg talked about it last week. I mean, Germany shut down 6 nuclear power plants, and yet all they do is talk about climate. It's bullshit. If they really cared about lowering their CO2 emissions, they would have never have closed those machines. Those perfectly good, highly rated, by the way. Germany had the best rated nuclear power plants in the world, and they closed them down. So it's, it opens the door for a lot of criticism, and I think I'm happy to walk right through that door.
Well, anyone else? Keith?
Oh, I think that's all I'm allowed to say today.
Yeah, you're tapped out, buddy.
I'm tapped
You're tapped out. No more carbon credits for you, Keith.
But again, I encourage people to try to, pick up on this story, because that trend and momentum, it continues, and it keeps pecking away at you every single day. And then before you know it, that door has been closed.
Well, I think that's a good place to end it. I will say this. There's an article out today or yesterday. Ottawa, federal government spent $11.3 billion in interest payments during 2023's third quarter, record high, $11.3 billion. What's the word there, Keith?
Interest
rates are at historic lows, Glenn.
Yeah, that's right.
Oh
So
dear. Oh dear.
Oh,
I
dear.
wonder though, have you guys peeled back some of the numbers and the data behind municipal government debt? Like I said, you see these property taxes going up and up, and you're like, man, geez, 10% increase, 30% increase. Municipal government debt. I wonder how much they're struggling under the
Like I know
weight of.
we sort of went down through this conversation before, and I think we're just going to repeat it, and then a lot of listeners will correct us on it, um, which obviously means the three of us aren't learning anything. So, but it is my understanding that most municipalities you have to run a balanced kind of a budget.
Correct.
So I think any kind of borrowing they've done, maybe it's just more, year to year cash flow kind of financing. But it goes back to, just say because of assessed value of properties have gone up by 10% and they have more cash flow coming in, that money is spent. And as Rich would point out, you would hope it is spent to increase productivity somehow, in that city or town or municipality. But the big challenge is on the debt side. It goes up to the federal government side and then within each province. Because if we do get a recession, then tax revenues for those guys are really coming down, and they're the ones who are exposed, to debt rollovers. And we try to do that in a liquid market because that's what happened in Newfoundland back during the pandemic. Because they were the first ones that had to roll over some debt. That's when the Bank of Canada rolled in. So it is a good point, Steve, absolutely. But I think it's more of a weightier issue up the scale.
I know we're getting close to wrapping this up. I just wanted to bring that last point up. Is the Bank of Canada. There's been a lot of discussion on Twitter. People are emailing us asking what's going on with the Bank of Canada's repo market. It's basically the Bank of Canada intervening to provide liquidity. I think at this point, correct me if I'm wrong, it's $30 billion. Is there a story there? Is there anything that is unusual?
Do you want me to go, Rich?
Go for it.
No.
You're not worried about it?
Well, you always worry and look at these things, but it's not this unusual event. You can see the data, they always will use the repo market. The Bank of Canada will, it's always available to firms when they need to use it. But I looked into this now a few days ago, and it doesn't seem to be screaming anything. It's actually a lot less than it was over the last 3 years. It is trending lower significantly. Now, we don't live in a world of absolutes, with 0, 100%, but it doesn't seem like it's someone out there struggling. And, maybe that will change, in a couple of weeks with better
Something
information.
maybe to keep an eye on.
It just sounds dramatic, of course, when you see it's $5 billion, right? And it's just for one night, and then it's zero for a few days, and then it's 5 billion again. But what do you see with that, Rich?
Yeah, same as you. I mean, I think other ways that you can sort of corroborate the stress that may or may not be in the banking system is things like OIS spreads on the bonds that those banks have. So option adjusted spreads or credit spreads or credit default spreads, which are instruments that people can bet on worries in the bond market, or you can see the stock prices. So you always have sort of corroborating or maybe a contrarian or a counterviewing market action. You know what I mean? And so it'll never just be one instrument that goes to the moon and everything else stays stable. You'll always sort of get either 2 or 3 or 4 different instruments, sometimes wholly unconnected instruments, but all sort of share or reflect that same sort of market sentiment or market timing issue. Or we talked about sentiment before. I think it's really important. And so there you're not seeing any movement at all. In fact, actually bonds, sorry, not bonds, bank stocks have actually gone up quite a bit as interest rates have sort of have come down a bit. So, meaning there's less stress than we might have otherwise talked about. So yeah, and for me, it's sort of a nothing burger. Am I allowed to say that? For now, anyway.
Cut, baby, cut. That's a good place to end it. As always, appreciate the support. Loonie Hour. We'll see you next week.